Welcome everyone to the New York Alternative Investments Roundtable's February virtual event, The Changing Private Equity Landscape, the Impact of COVID, Political Change, and other various factors. I'm Ali Tocco, President of the Roundtable, and we're glad you're able to join us this afternoon. First of all, I'd like to take a moment to thank the Roundtable's sponsors. We are extremely grateful for their continued support. They're an active group and all from within the industry. So again, we thank them, and I believe the screen is available for you to see their names. Now for a few logistical issues. If you have not participated in one of our events before, we like to use the chat feature. Our speaker, our moderator will all be able to see the questions and will actively engage. So we encourage you to use that. And the last thing I do need to add is that these comments are strictly off the record. So if there's any press or tweeters out there, please make sure you check with the panelists before you put anything out on the ether. So to that, we'll go to the event. Today we're gathered and excited to welcome a panel of leaders and experts within the private equity industry who will discuss some of the ways PE is adapting to current events from the pandemic to climate change. Before we begin, let me introduce today's moderator, Hugh Newang, who is a managing partner at Knickerbocker Financial Group. Prior to his current position, Hugh was the co-founder and CEO of wealth management platform at ClearServe. And before that, he was the vice president of business development for North America at Gerson Lehman Group. Now I'd like to hand things over to Hugh.
Good afternoon, and thank you very much, Ali, and to the New York Alternative Investment Roundtable for organizing and hosting this event. Logistical note, the team and I will be keeping track of the questions that you submit via chat, and we'll make sure to reserve 10 to 12 minutes at the very end for Q&A, but we'll reserve a little bit of latitude in case there's a topical question to field one or two of those during the discussion if applicable. So I had the pleasure of introducing our esteemed panelists who are joining us today. Jim Anderson is a managing partner and of private equity firm Clearview Capital, which he co-founded in 1999. Clearview specializes in controlled private equity investing in the lower middle market across manufacturing, distribution, consumer business services, and healthcare services, with a focus on North America and companies that have an operating profit of 3 to 20 million. Prior to founding Clearview Capital, he was a managing director at private equity firm Capital Partners, where he worked on acquisition due diligence and portfolio company optimization. Earlier in his career, he was a strategy consultant at Mars & Company and a senior field engineer in the Middle East, based in the Middle East at Schlumberger. Welcome, Jim. Sorry for the light flashing before you, but you have an impressive bio, and we're happy to have you.
Thank you.
And, we originally had Adam Weinstein from New Mountain Capital on the invite list, but he had to unfortunately travel last minute. But we're delighted to have his esteemed colleague, David Cocolette, joining us as a panelist. David, by background, is managing director of New Mountain Capital. Prior to New Mountain, David managed investment product marketing and client coverage Oak Hill Advisors. Prior to that, he was at a small firm called Goldman Sachs, most recently as managing director and head of the markets coverage group within the IMD division of GSAM. And earlier in his career, he was a banker at Lehman Brothers and Bankers Trust, focusing on transportation and industrials, primarily in M&A and corporate leverage finance. He currently serves on the board of directors of Goodwill Industries of New York and New Jersey, and Fostering Change for Children. Thank you, David and Jim, for joining us both today. Welcome, gentlemen. How are you? How are you both?
Well, doing great. Thanks, you.
I think one of the advantages of this virtual event is the ability to congregate easily on a virtual forum, if you will, within that we have a great list of attendees as well. Let's kind of jump into it. We have limited time together. What a year it has been in terms of the global pandemic. And in terms of COVID, maybe I guess the first question that we're interested in is, walk us through how COVID has affected your business, perhaps your firm's culture or operations internally and how you operate, as well as potentially, externally, how you conduct business in terms of how you think about markets, how you think about working with your portfolio and your companies, and just give us a sense of internally, externally, what kind of impact it has been. And maybe Jim, we'll throw it off to you first. Give us a flavor.
Sure. I mean, we've all had to be adaptive in a time that none of us has ever lived through before. We are fully remote. We had a halting, partial restart of our office before shutting it again. And I think we've managed to pretty well, actually, in this flip to remote everything. But quite honestly, it's a struggle, particularly as we try to mentor our younger and newer employees. So it's something we worry about, and I would say we don't have a perfect answer for. We're working pretty hard with that. And it's similarly with our portfolio companies, the ones that have been in the portfolio a long time. It's easy in a sense because we know these people very well. We already have a great relationship. But for younger and frankly, we did 4 platforms, actually 5 platforms in the last 9 months. It's a lot tougher because building those face-to-face personal relationships is really important. If the company just does screamingly well out of the box, maybe it's not as big an issue. But as we all know, and particularly in the lower middle market, things never go as you expect them to. In fact, we joke all the time that we model everything, so that way we can be sure we know what won't happen, because we know that it's not a straight line in business. So we're struggling to learn how best to build those relationships. And I think one of the benefits, though, is what used to be one long meeting has now become 4 shorter Zoom meetings. And so there's some good that's come out of that. So I'm not sure I really fully answered your question, but I would say that we are far from experts. We're adapting, we make mistakes, and then we make course corrections as we go along.
Yeah, and I think you mentioned, we had talked a little bit, Jim, before about how you've done some deals, but you had the opportunity of meeting those teams in person prior to the pandemic. And so it was a continuation of that diligence process that had begun before.
Well, we were lucky. We had 2 deals in process that went on hold, but we had already met the management team. And then we did 3 other deals where we were able to visit them when things were pretty good in the summer. So the timing actually worked out very, very well for us. We were fortunate in that regard.
Yeah, and with the vaccine rollout, I mean, you may never have to meet teams remotely ever if the vaccine gets rolled out. God willing, perhaps.
I don't see us ever closing a deal where we don't meet management in person. I don't think we'll ever do that.
Yeah. David, how about you at New Mountain Capital?
Sure.
How have things been for you guys?
Sure. And first off, thanks for having me today. Nice to be a part of this. Thank you to everyone. So New Mountain, we're also a middle market firm. We focus on mid to upper part of the middle market in general. I think things that probably pretty similar in terms of some of the cultural challenges that Jim mentioned around the younger side. That's probably the biggest pain point, in my opinion, to date. And for example, one of our colleagues I was just on a video with recently, he started 11 months ago. So he has not been literally with us at all. And training, culture, all those things that really matter in the development, I think, need to be backfilled as we get back and we all get back together. So I think Jim identified what is probably the biggest pain point that we have as well. On the business side itself, we were fortunate from a portfolio perspective that we had a few businesses that were challenged, but most of them are tech-driven and software-related business services, that type of thing, and some healthcare IT. So we were fortunate from an industry standpoint, but I would say that we really had to pull together as a team as this was all breaking at the headquarters level of New Mountain. And I think our team did a really nice job there. We've thankfully added a lot of operating talent over the years that was able to triage. And we tried to create what I'll call a center of excellence, which I think was really important for us in terms of most of the issues the companies were facing at the portfolio level had nothing to do with their industry. It had all to do with the macro, keeping employees safe. How do you think about reopening facilities, distribution facilities, factories, whatever it may be? How do you think about the go-to-market issues that you're facing? How do we help them move remote? And we were able to centralize a lot of these key pain points for them, where I think we actually added a lot of value that left alone, they might have had a much harder time. Yeah. So that was pretty important, from a firm and tying in to the portfolio company level. You also asked maybe an ecosystem question around counterparties, and we have lenders in most of our companies. I think what we tried to do was triple down in terms of communication with the lenders as to what was going on. Again, thankfully, we largely had good news, or at least, hey, it's not as bad as you might think sort of news. But we really tried to emphasize communication with all of the counterparties, all of the employees, really just trying to over communicate to some degree. And then we actually have another lens that's kind of interesting, just related to the question. We also have a private credit business where we lend to other sponsors. And that gave us a whole different perspective about how are we being communicated to by the owners of the businesses. And I've got to give a lot of credit. And we're largely lending to middle market companies. The middle market community, I thought, as sponsors, did a really good job working with us, telling us what was going on as a lender, and just in the sense of not being surprised by things, getting real-time updates. And I think overall, the middle market ecosystem will come through all this, I think, pretty well and more battle tested.
Yeah, no, it's incredibly positive tailwinds I'm hearing in terms of the pandemic being very challenging, but from what I'm hearing in terms of how you've had to kind of really focus on core competencies and really serving, even though you're a PE firm and an investor and you get the principaling hat on, you're really working as a partner, I'm hearing, to a lot of your companies and to a lot of your counterparties. And so in tough times, you're having to kind of dig in a little bit and really kind of find out, are these relationships strong? How can we forge deeper ties, especially when things get tough? So that's incredibly positive.
And I would add one more thing to that. We also happen to be starting our fundraise for our global flagship fund, so we had to deal with all of that too. And credit to the investors and allocators and consultants out there. I mean, and not just for us, but for many other firms. They really saw their way through all this and adapted as well. So it's a really interesting point.
I'm gonna call latitude on a question that's just come in. This is CNN breaking news. We've got a question from an attendee in terms of how have your firms, I'm just gonna read it verbatim. How have your firms adjusted capital raising with quote unquote new investors? E.g. virtual due diligence. How has that changed how's the game changed perhaps on that front, if at all?
I'm happy to go. I'll go very quickly, then I'll turn it to Jim. But we just faced this. We literally had just launched, and then the pandemic hit. And it took a little while, but I actually think we were able to do a few things for investors. One, we were able to showcase more of our talent and more of our portfolio companies because people were operating virtual. So that worked. We were also able to get people globally that otherwise would have been a little harder to get at. And we ended up having a surprisingly large number of new investors commit to the fund. So I'll stop there and turn it to Jim, but we had a pretty good experience with it.
Yeah, I don't have a lot to add simply because we haven't been in fundraising mode. So the usual introductory calls that I have on a regular basis anyway continued. It's just that none of them was in the office, but that didn't matter. In a way, it's easier to reach people because they don't have to travel. But we were not in formal fundraising mode, so I can't really do that.
Yeah, got it. Understood. I'm gonna shift gears a little bit to the next question, just because this is a topic no one is talking about, SPACs. I'm a little bit tongue in cheek in that. So the SPAC market has been an important driving force in the public capital markets as of late. Approximately 79.9 billion, almost 80 billion was raised in 2020 last year via SPACs, representing about a 462% year-over-year jump from 2019. If at all, how's that affected your short, medium, long-term views for your own private equity firms in your portfolio companies, and how much longer could those tailwinds continue? I'll start with David this time, perhaps.
Sure. No, and look, it's become obviously a big topic of conversation. We have not sponsored one. We have certainly been approached by every banker that you can imagine wanting us to do one, and not to say we won't ever do one, we might, but at this point we have not. We do have our first sort of entry in the stakes in that, and I won't disclose the company, but we have a company that we own that is contract to be purchased by a SPAC. And I think it's one of the highest quality SPAC operators from our perspective. And I think the business itself makes sense in a SPAC public form as that transaction gets closed. So we'll be learning a little more about it. First headline, I think that is clearly a space that's here to stay. And I think it does provide private equity a whole nother avenue for both capital raising on a permanent capital basis, which is always attractive to sponsors. I think more importantly, it does create other exit optionality for the portfolio. And we've got several companies that we currently own that are being pursued by SPACs. And that for us is helping our, for lack of a better term, auction dynamic around those businesses. And we can create potentially additional value. And in many cases, we can roll equity in a more elegant way than in a conventional rollover into another sponsor's deal. I also think that as we look forward 3, 4, 5 years, you're not going to see the same level of velocity of new listings. I mean, there would just be an indigestion issue that plays out. But I do think they're here to stay. And again, looking forward 3 or 4 years, there will be some great winners, good sponsors running them, and good owners, good businesses inside some of these. And then there's going to be others that really languish due to the business quality is not there, the management and ownership is not there. And obviously across the whole sector, one needs to be a little bit worried about dilution in economics.
Yeah. I have a follow-up question for David. Let's turn over to Jim first and let Jim opine on this a bit.
It feels a little bit like a gold rush to me, and gold rushes almost never end well. But it really is a symptom. I think the rise of SPACs is a symptom of the fact that the Fed has been printing money basically, through almost my entire career in private equity. There's a lot of money out there looking for a place to go, and this is just another place for it to go. We've all benefited, I think, those of us who've been buying and selling companies over the last at least decade and really more, in just overall rising valuations and multiples. That's not going to go on forever. Now, it's gone on, frankly, much longer than if you'd asked me this 5 years ago, I would have thought we were close to the end of it and I would have been wrong, but it's not going to go on forever. It can't. So to me, it's a symptom of just easy money. And I worry that there are a lot of bad choices are going to be made. So my feeling is that there'll be an awful lot of SPACs that overpay and don't perform. That's kind of my expectation.
Yeah. And Jim, I don't think anyone's going to disagree with the cautionary tale of what we're in, but generally when we speak with other kind of sponsors, they're generally very positive. Another avenue, liquidity route, in addition to traditional IPOs and direct listings, it's there, but I like that there should be some voices of reason about potential concerns around it and the likelihood it may not continue, but everyone's very happy right now. And I spoke with a large sponsor. So this firm is a multi-billion-dollar, half their business is early stage venture from seed to Series E, F, G, and then other side is LBO. And I said, how do you feel, such and such partner? How do you feel about SPACs? And he says, well, we're testing one right now, meaning we're about to merge. One of our portcos is going to merge with a SPAC, and why don't you check back in 2 to 3 months? And so he was happy and cautiously optimistic, but had a little bit of the back of his mind, left side of the brain logic around it could go wrong. There could be some complexity around it, but he said, I'm generally very positive. Yeah. Okay. Good. And one other question, one follow-up question to David, sorry, very quickly, is you said in the future, just for my own clarification, you said that you might think that you thought there might be less listings in the future. Did you mean traditional IPO listings or on the SPAC side?
Sorry. What I meant is that I think we're not going to see 3 SPACs going, effectively going public a day kind of thing. The pace of the last 6 months is not sustainable. And that said, I do think it is an industry that's here to stay, and hopefully at higher quality than it had been historically.
Got it. Understood. On the SPAC side. Okay, very good. I'm gonna then pick a topic that is not ever discussed, politics, but I'm not going to go into politics. I will ring fence it and ask both of you, politics aside, putting all the political considerations aside, what macro changes do you expect or hope to see with the new Biden administration? And I'll You may have seen in the front page of the Journal this morning, the chairman of the Fed, Jerome Powell, saying that he expected kind of the easing of monetary policy to likely continue to allow the economy to further recover during the pandemic. What are your thoughts on that? There are a lot of concerns around inflation and the historical kind of lax easing of monetary policy. What are both your thoughts on that? We're going to start with Jim this time, perhaps.
Clearly there's been easing of monetary policy, as I just mentioned, basically for a long time. And more of that will be good in the short term. It's hard to imagine that there won't be some negative effects down the road. And I can tell you in our portfolio, we already see inflation. I mean, we own 15 companies. We don't have a single company where we have the ability to hire everybody we need. Not one. And which was it's a little strange when we talk about unemployment, people being out of work. But there's absolutely wage inflation is coming fast and coming hard. You see it in the resin market. Commodities are up. I'm not sure they're up everywhere, but certainly in our portfolio companies, we see it. So I don't think there's any way around having inflation. But again, I've said this before, it's gone on far longer without much inflation than I ever thought was possible. So another thing I'm absolutely sure of is that my ability to predict the future is very poor. But I do expect continued inflation. So there's a negative side to everything. And I think it's pretty tough to print money forever and think there'll be no consequences.
Mm-hmm. Hey, David, what are your thoughts on kind of Biden administration and macro changes and outlook in the future for PE, perhaps?
Yeah. First off, while Jim may be self-deprecating about his predictability skills, I think we agree with his sort of forecast around all that. And look, when you just think about what's going on around us, we have to be cognizant of that likely outcome. But whether it's, as it starts to manifest itself, we'll have to see what the timing is and the magnitude. But I guess the way we look at things is that between owning private equity businesses through obviously through our portfolio, having a credit business that is basically all floating rate in terms of the exposure, where we've already taken the pain on LIBOR down to near zero and it's sort of only upside. And then we have a real estate business as well that owns real estate assets. We're actually, I think from an organizational perspective, we're well positioned in kind of almost, I don't want to say looking forward to inflation, because we do worry about the points Jim made around, in particular labor and high quality labor into our businesses. But we're not like fixated on it or overly worried about it for ourselves. I do think it'll be really interesting for our whole ecosystem and world when you start to reset. If the 10-year moves, and it's been moving very quickly, if all of a sudden we wake up and the 10 years back at 3%, and then investors actually have alternatives and some of this quest for yield, which manifests itself all over the place like SPACs, which Jim rightly pointed out, we'll see how that affects asset pricing in the less liquid end of the market. And we're all seeing the benefits of sort of that global quest for yield. But that can reverse, and I think we all have to assume that that will over time, and that's likely one output of a higher inflationary environment ultimately. Yeah,
I'm going to thank you so much, Dave, for that. I'm going to do another CNN breaking news. There's a question that's come in as well that I also had in my mind in terms of the Jim had alluded to a potential kind of overhang of there's a lot of capital in the market. There's a slight, some would argue, an overhang of capital and supply of capital into PE over the past 2 years. There's a lot of dry powder. With all that have you seen on a percentage basis, what have you seen in the past 12 months, 18 months in terms of any effect, if at all, on valuations? Has that kind of increased valuations? I think I know the answer, could be. And then second part question, is that likely going to, has that kind of, created more auction processes and more competitive bidding in general? What are your thoughts on kind of valuations and competitive auctions in your industries? We'll start either Jim or David. Feel free to chime in.
Why don't you go ahead, Jim, and I'll follow.
Yeah. Sure. I mean, I think there was a momentary dip in valuations when the pandemic started, but I think what you've seen now is that companies that performed well, if anything, the multiples are even higher. So it's always been a little bit of a have and have not kind of universe, but I think it may be even more of that now. So high quality assets are going for really, really high numbers. And one of my concerns here is, like, we talked before about how our ability to mentor and train our younger people is challenged a little bit in this environment. So I don't have the ability, when everybody around the table is saying, let's bid 12 times, let's bid 13 times, to pound the table and say, yeah, but you know what, 5 years ago or 7 years ago, or when I started, that was a 7 times business. You know,
Yeah.
It really is unbelievable what has happened to multiples during my career. It's just, it's unbelievable. And now I think the world is a little bit different place, but interest rates don't necessarily need to stay this low, and there will be challenges to valuations as interest rates rise, because there will be other options. So we're very cognizant of what we're paying for businesses up front, and over the last couple of years have modeled multiple contraction, which is something we never did before. And maybe it won't happen, but I want to be sure if it does, we still have a decent investment.
Yep.
Yeah, I'll follow on behind that, and yes, we've all observed higher valuations, and that's, it's a function of many things that I think most of the audience is pretty familiar with. I think there are some good news and bad news pieces of that when we think about the private equity world. One is, interestingly, some of these higher valuations are actually bringing higher quality businesses out into our ecosystem that otherwise might have found their way to IPOs or other, who knows, maybe SPACs will now compete. But in any case, the quality of the businesses that we've been seeing are better than ever. And I think it gets better every year. Now that also may, that becomes a bit of a virtuous circle on comps, and then the B business in the same industry gets valued. It gets pulled up in its value. So I think people need to be very careful. And Jim is right. We have the same phenomena around our table where, our CEO is 65. He's been doing this for 40 years. And he'll bring out the story from 38 years ago about how Sector X traded, like this. And there's always a little bit of eye rolling, but I think people appreciate the long-term perspectives. Other comments: there is more equity going into deals by and large now than, quote, the old days. I think that means two things. One, there should, out of the private equity industry, be fewer bankruptcies, everything else being equal, but probably potentially lower returns from an equity perspective. I think that also the multiple considerations are very real, but I do think that the middle market in particular is much better equipped than it used to be about business building and adding value to these companies that are $100, $200, $500 million of value. And that still creates, I think, a real good opportunity to be playing for alpha, as opposed to just letting the tides blow you around by what the multiples are. And so there will be more pressure, though, on the sponsors to deliver the goods there, because our expectation is multiples can't go a whole lot higher. At some point, we're going to be tapping out here. And like Jim said, if you're buying something at 12, you really better be analyzing it. If your best bid is going to be 9.7 in 5 years, you better be comfortable that you can make the return.
Mm-hmm. Is it ever an option where a sponsor just sits out the full year and doesn't do a deal? Does it ever get that bad in terms of, from a valuation perspective, not fitting into your model or your expectation?
I know some sponsors will do that, not for us. Yeah. And we really don't subscribe to that sort of vintage mentality that I think some may do. And I have friends at other firms that say, oh, we're not doing anything. These are the guys 4 years ago that weren't doing anything either. And they didn't put any money to work. And some of our best deals happened 3 or 4 years ago that we bought. So we don't look at it that way. We're trying not to get too cute about valuation and sort of overthink it, particularly given if we're putting our operating model to bear. We hope to put as much in our own control as possible.
Yeah. Jim, what do you think?
I think we have a little bit different perspective on that. I mean, we've always been a little deliberate in putting money out. So when we raised our last fund, we were very slow to activate the fund, but then immediately post-pandemic, we did 5 platforms because we found valuation was better. So it wasn't a decision to sit on the sidelines. It was more of didn't find something that we had conviction in. We found a couple, but not as many as normal. And then we were able to find conviction and did a bunch of deals that I think are going to be really, really good. But what I have seen, what's a little worrisome, is some firms that jumped up in size pretty dramatically and then invested all that money in 18 months. That's pretty scary, because if you did that, say in 2019, you might be pretty sad today. So so it's, I think it does make sense to be, because it's a little bit like dollar cost averaging, right? You should be investing consistently, but we're not going to put money into something unless we have high conviction. And at times when the market is frothy, we're less likely to find things in which we have high conviction.
Yeah, I would add on I'd add on just one quick thing on that. I think it's really important that investment committees at PE firms, that they are thoughtful about not changing the return goals of deals just because, well, the market's hot and we need to chase this, and accept a lower return. I think we've tried to be incredibly consistent with our underwriting expectations of our deals. And I think for those of you that are allocators out there, obviously test your managers on whether they are adjusting the bar, because I think to Jim's point, if you're adjusting the bar to put capital out, that can, it may not end with bankruptcies, but it could end with mediocre returns.
Yeah, I agree.
Makes a lot of sense. Okay, we'll move forward a little bit and shift to another question here. In terms of this primarily centers around sources of liquidity and LP capital for sponsors, but there's been a trend line in terms of PE firms being ahead of the curve and how they raise capital for funds and work with their clients and their LPs. Many private equity firms are publicly listed and floated on exchanges. PE firms now have IR sponsor groups that are segmented and specialized and focus on particular high net worth bands, including in terms of family offices, capital, high net worth individuals, marketing and fundraising, et cetera. There's even talk that your contemporary firms like the Blackstones and the KKRs and the LBO side and Carlyle are thinking through further going down market and targeting retail investors for specific products. What are your thoughts on this in general? This is it seems like a never-ending race. I mean, never-ending is me opinionating a bit, but it seems like a very aggressive push down market into capturing further lower down market bands of potential investors. What are your thoughts on that, Jim? Just in general, perhaps good or bad for PE, or wait and see, perhaps.
Well, I think it depends on this opinion, right? I mean, we don't. This is a world in which we're not familiar, right? We're a small, relatively small, lower middle market fund focused on smaller businesses. But when I look at a place like Blackstone, for example, they're money managers. They're not private equity firms, not really. I mean, they're looking to try to return 50, 100 basis points better than than benchmarks. I mean, we need to return 1,000 basis points or 1,500 basis points better than those. So and we also feel like we're much better aligned than they are. I mean, for me, any wealth that I create, the vast majority of it is going to be in carried interest.
Yeah.
The profits from those firms, I just read an article the other day, but they're increasingly relying on management fees. Well, yeah, of course they are. So it's a very different world. And I think publicly traded private equity firms can make sense? Sure they are. But from an investor's point of view, you really have to think about what you think you're going to get from that. And the alignment of interests is not particularly great in these big firms that are just bringing in oceans of management fees.
Yeah, and Steve Schwartzman and John Gray are not on the line, so feel free to poo-poo on Blackstone all you want. I'm joking, but I would agree that they have a very diversified business, of which private equity, kind of traditional PE and LBO, is only a segment of these days. So I think, yeah, they've got their own kingdom. David, what do you think? What are your thoughts on kind of the move to down market and harvesting other types of investor capital?
Yeah, sure. And a few maybe scattered thoughts around that. I think, first part of the rationale that's going on is aside from just trying to find more pockets of growth, and you just look at the asset growth in the quote retail channel, which is obviously a lot of different channels. Those pockets are just growing faster globally than pension funds, sovereign wealth funds, insurance companies. Okay, so part of it is you got to follow the growth if you are a firm of that scale. I think there's also some advantages where there may be a little less fee. There's distribution costs, but there may be less fee pressure than if you're Blackstone going out to the state of Washington for a $700 million mandate. They're going to be discounting fees. And also, I think there's a greater pressure on the ecosystem to deliver those big institutional investors, and we're getting this pressure for co-investment. And there's only so much to go around. So the retail channel doesn't require that. Higher fees, pre-distribution costs, arguably quite sticky, no single point of failure in terms of an investor, deciding not to allocate and don't need co-invest, and it's growing fast. And you can effectively, through these vehicles, create what's perceived, particularly for the public managed companies like a Carlyle or Blackstone, that's effectively perceived as permanent-ish capital. So that carries a higher multiple for them. Now, we can talk about those incentives separately, but I think there's a lot of reasons for that. We look at it as a firm that's we're much smaller, 30 billion of assets. As it's interesting. We've had a little bit of distribution. Our last fund, we did a high net worth platform distribution. It was pretty expensive, but it was very successful. It does help diversify our investor base a little bit. And we are working on further building our brand out, for lack of a better term, into those channels. Also, not really so much for private equity, but we have these other yield products where there's a good natural home within those communities. So we are looking at that distribution more and more as a firm, but we really need to partner to get after it, because we're not going to go out and hire 50 wholesalers to go run around the world to do that. We're going to likely partner. I think it's a really important channel. I personally am thinking more about it, but I also think you need to sort of pick your spots as to how you play it, depending on the organizational need. Got it. I'm going to read a question. We got a breaking news question from one of the attendees. I'll read it verbatim and I'll give you my interpretation, perhaps. What are your thoughts on the push by mutual funds and the SEC to have PE investments in funds? I'm not sure if that's a particular regulatory change, but I think she may be referring to kind of the broad blessing of the SEC and FINRA in terms of opening up alternative investment access to the everyday investor. And so their Jobs Act, direct startup investments moving to now, there is broad blessing, especially with the personnel in those divisions who are open to cryptocurrency and alternative funds, and then alts, if you will. What are your thoughts on, is this a good thing, a bad thing, or a buyer be very wary of this? You can do it, but you have to be educated. Jim, what are your thoughts on that? We'll start with you.
Well, I would always say buyer beware. It's always bugged me a little bit that the SEC feels like it should be in a position to make decisions for individuals on what they can and can't do. So I think it's good that the access is open, but I do think a lot of people will get into something they don't understand, and that's a problem because our investments are illiquid. They are. I mean, if you invest in a Clearview fund, we may return some money pretty quickly, and maybe we'll return some of it 12 years from now. I mean, if you're an individual, you need to really understand that getting into alternatives. But I've never liked the idea of the SEC saying, we don't think you can make decisions for yourself. I don't like any government agency doing that.
Mm-hmm. Yeah. Davis, what do you think?
Yeah, I'll follow on there. I agree with Jim on the premise of call it the democratization of alternatives. And in many cases, it does seem sort of weird that you can't buy it's hard for an individual to buy maybe one of the safest private equity funds out there that somebody may have, but they can go out and buy any of these cryptocurrencies, in 30 seconds. That seems a little strange. Yeah. And I agree. I share Jim's view on the liquidity issue is very real. And we've seen this over the years. The problem is generally liquidity when there's going to be a problem in this marketplace. And you've seen whether it's, European distribution, I think as being maybe the clearest example historically, where there's ends up being problems because there are vehicles that are marketed that turn out to be problematic because of the lack of asset liquidity. And I worry about fees on fees on fees ultimately to some of the people in that channel in a world where returns in general at the gross level may be declining, maybe not. I think the liquidity and fee issues are very real. I think in general, you might see when you think about some of the activity, and this could be very positive, like the time-dated funds, time-targeted funds that are out with Vanguard and some of those big complexes for 401ks, for example.
Yep.
I think that's a great natural home for Vanguard to be putting 5% at the Vanguard level into quality private equity, maybe infrastructure assets, et cetera. To me, that makes a lot of sense. But then you've got Vanguard in the middle who knows how to manage liquidity, and they can select managers like an institution. I like that model. I think that'll be a place in the 401k space that the world will start.
Yeah, I think I would agree with you in that in terms of like the mutual fund complexes are well positioned on distribution, and they probably have a lot of data around their own investors that be able to make good recommendations in terms of alternative allocation. So, and to your other point, I think the past 15 years or so, they've had these interval funds and these tender offer funds that help kind of help manage the asset liquidity to David's point. And so there are options in the marketplace, but that for a retail investor to be able to find and educate himself or herself on these individual interval funds that then have these illiquid holdings I think it's a steep uphill ask of them, perhaps. But that's my opinion there. We've got, I'm going to scan a little bit and see we are 2 minutes early. The train driver in me says that we're about 2 minutes early and we're doing well on time. I wonder if any other kind of New York Air team members have any questions that we should go through. We have one Q&A question that we have not. We may jump directly into Q&A a little bit. We've got a couple questions in the hopper here. Question from the audience: are you concerned with SPACs? This is related to SPACs. Are you concerned with SPACs as a potential competitor to PE funds that they'll drive valuations to levels which are not reasonable? So SPAC is a PE alternative or competitor and adversely affecting valuations. We're going to go with Jim first, perhaps.
Well, I mean, I'll follow on what I said before. I mean, there's more money out there. SPACs is just one example of liquidity driving up valuations. I guess part of my question is, I wonder whether if a couple of SPACs don't do well, whether they'll be pushed for more regulation. Because if you're a private company trying to go public, it's really hard. But now it's kind of easy to go public through a SPAC. Like that, something not quite right about that. But could it drive up for larger deals, drive up valuations? Yeah, of course it could. It's just another competitor and another outlet for liquidity coming into the market.
Yeah, I would agree with that. And I think and we were looking at a business recently where we actually stepped out because it looked more likely, and this is an upper middle market situation. I think that the enterprise value of the business was $600 or $700 million. We actually stepped out of it because it felt like there were a couple of SPACs circling, and our time is so precious. We're like, yeah, we're just not going to go spend time on that. The outcome is still undetermined, but that's one simple empirical example of, they are competitors. On the other hand, a lot of what we see out there, they're not aside from the vehicle, they're not necessarily value add in the sense of what I think most high quality PE firms can bring to bear from an operating and growth perspective. So I think it may be a better fit for a business that's sort of built and maybe it's ready to just be run from a cash flow perspective. And there's the valuation arbitrage that can be had through the SPAC process. But I think when you need to get a little more creative, or you're a founder and you've built a business of $400 million and you think you could make it to be worth $1 billion with some additional help, most SPACs aren't going to be the solution for that.
Yeah. And again, we're not even addressing some of the potential trading issues where the hedge funds of some of the large institutions have come in and essentially are arbitraging the warrants on the trading. There's a lot of consequences of that we won't speak about. But I'm going to push forward a little bit in the Q&A, Hopper. We've got a question from the audience. How are you handling underperforming companies in your portfolio? Different challenge during this pandemic? Are you doing anything indifferent in terms of handling underperformers in the portfolio, Jim?
I mean, I wouldn't say we're doing anything different. It's just a little harder because normally if a company is really struggling, we probably spend more time in person with them, which is more difficult to do now. This is not a troubled company we have, but we have a company in Canada where several of our management team members live in the US. Well, they haven't been there 9 months because to go, you have to literally quarantine in a hotel for 2 weeks before you can actually be released into Canada. So there are some really weird things going on that make dealing with companies much more difficult. But the issues are still the same. Analyze the situation and deploy whatever assets we need to help them. We've worked just as hard on any company that has struggles now as we did before. It's just more difficult to deal with because of the inability to actually go and be in front of them all the time.
Yeah, David.
Yeah, I'll call out 3 no-name situations out of our portfolio. We really had three companies that had very notable challenges from COVID. One is an attractions management business. It manages the affairs at stadiums and other places where people gather. Think, high-rise towers and other sort of attractions. Obviously, a tough place to be, but a great franchise. We doubled down in terms of activity, working with the business in terms of there was some cost cutting, of course, to go through. That's never fun, but I think it was done very thoughtfully with the plan of trying to get as many people back from the original payroll as possible. Really trying to be on offense around. There's some weaker competitors, and we actually helped the business position itself more strategically. We fortunately had very limited leverage on the business, which enabled us to sort of see through it. We actually just sold the company to another sponsor. I think the new sponsor is going to do really well. This is a franchise asset. It just didn't necessarily make sense for us to, after a 3 or almost 4-year hold, to be that owner. But we think it's going to go very well for the new owner. The second example, a dental practice business. Obviously, that was pretty tough for a while. We're back to about 95% volume, and that should be fine. But we did have some leverage on the business, and we had to work with the lenders and explain our operating plan. And I think we've come to the other side of that. The third one, perversely, is actually an emergency room physician management business, which on the surface, that should be like, okay, well, there's more action in the emergency rooms. Isn't that good? Mm-hmm. It was actually bad because many emergency rooms had much less volume because people were scared to go to the emergency room for the traditional things, or there were fewer. I mean, it's good there's fewer car accidents, but the reality was there weren't fewer heart attacks, but the people weren't showing up. Not sure that's good for society. That business obviously is coming back now, but each one had its own idiosyncratic issues, and that back to my communication and just trying to do right thing by these businesses.
Got it.
I think we found as well that, at least in our portfolio, when we needed to work with our lenders, we've always had good relationships with them. They were very, very understanding and willing to work through whatever issues we had. And I would say probably even more than normal, because I think they recognize, boy, this is tough everywhere, and they don't want to own these companies. They want to make sure we stay engaged if we have issues. Yeah,
long-term greedy and really work with the partners on that. I'm going to go in another particular order on the Q&A hopper here. Sadly, this is an anonymous attendee, although I would like attribution for this because I like this question. Both your firms are generalists or appear to be generalists in terms of industry focus. Are there any industries that you like in particular as things stand now? And then my add-on question is, it's counterintuitive. People think that you have to be specialists to command a premium, but you both your firms are examples of doing quite well as generalists. And so what are you looking at now, and what are your thoughts on generalists versus specialists moving forward, perhaps?
I mean, I guess
you want to go first?
Sure, I'll start. We've always been a generalist, and that's in a world that really, where I think LPs value specialty more and more and more. But here's the issue, and I think it really revealed by the pandemic. So let's say you're a restaurant investor, and that's what we're really good at. We're specialists. Now what do? You have to invest in restaurants. You don't have a choice because that's what you specialize in. We've always believed, particularly in our part of the market, that our companies, regardless of industry, are facing the same kinds of challenges. Because we like to say that we invest in teenage companies, we help them become adults. Our teenagers are all different, but they all have the same kinds of issues. So we found that a solution that we found in a manufacturing business might actually work very well in a business service business. So we're really focused on how do we help companies double and triple in size and become more professional and become adults. We really care about the industry, and it's worked out very, very well for us because in a way, we don't have blinders. There's no constriction of like, this is how it has to be done in that industry.
Yeah.
We're also fortunate. We for a long time, not for a long time, but for some period of time, have had a thesis around outdoor products, outdoor enthusiast kind of products. Mm-hmm. Well, we're doubled down on that now because it was a good idea before. It's an even better idea now. Mm-hmm. Because I think people, I think this move toward being outdoors, while it will come back somewhat, it's a ratchet up. I absolutely believe that. So that's one example of a place that we're very active. We did 2 deals last year, 2 platform deals there last year, and we'll do more in that space.
That's great. David?
Yeah, we're a little different in the sense that on the surface, it looks like we're a generalist, but we call ourselves a defensive growth specialist. So the first way to think about that is anything cyclical or exposed on input pricing in a material way, we won't do. So we don't do metals and mining, energy, automotive, anything heavy to medium industrial. We don't do restaurants. We don't do retail. I mean, you put about half the economy, we would literally people approach us and we're like, no. I think the guy in the train says, hey, we're selling company. I'm like, no. And they're like, what do you mean you won't look at it? No, we won't look at it. It's, we are maniacal about that. Now, the stuff we do, we try to build very strong sector expertise in the spaces that we drill into. Now, healthcare IT is a good example. That's a big industry, right? There's a lot going on in healthcare IT, but we really are breaking down the taxonomy inside of it to areas where we really want to be in healthcare IT, which is today largely around areas of payment integrity where we've had success and we've got a vision ahead. There's a lot of the more generic healthcare IT we won't look at as one example, or life sciences. There's area of life sciences, and particularly in product supply, that we've done very well in historically. We're trying to leverage those experiences. Or software. We do software investing, but we're not trying to compete with Thoma Bravo or Vista. Those guys do great. We're going into the industry sectors where software intersects with some area of expertise for us. So we're really unbundling the half of the economy that is non-cyclical into areas of special focus. And that's how we try to compete in a world where, as we talked about before, there's a lot of money sloshing around.
Great. I'm gonna look at reserving time for Ali to wrap up. So we're gonna take one more final question. Do not be offended if I've not gotten to your question. This question was submitted 3 times, so this attendee is incredibly persistent, and persistence wins trumps all, I think, in this case. Hi, verbatim. Hi, what are your thoughts on emerging markets, i.e. Africa, e.g. Africa, asset classes, taking into account the impact of money easing monetary policy during the COVID moment? So if there's easing of monetary policy, does that have any impact at all on being able to allocate to emerging markets in asset classes in those regions, is the question. We'll go David.
Sure, and this is me speaking personally. New Mountain has we really are a North American investor, but just being a student of the world and thinking about things more holistically, well, I think areas like that are going to see, for the same reasons that other risk-seeking assets are attracting attention. I think that money is going to be moving there, and it's going to be moving in other areas of emerging markets. Generally, valuations in emerging markets, equities, for example, are more attractive than developed market equities. Africa, being one example. If you drill down into those exchanges in South Africa or in Cairo, where are the primary capital markets, there's probably activity there. My general view is in emerging markets, I think you generally have to stick to equities. I don't know why you'd want to own bonds where the currency impact can completely dwarf the potential coupon you can be earning. So that's just one personal point of view.
Yeah, thank you, David. And Jim, you've got the last word here on this question.
I quite honestly, I can't add anything to that. I think that David explained it well, and it's not really my area of expertise.
Yeah. How's your arm, by the way? That'll be my follow-up. Do not raise your hand. Good luck post-surgery, and your range of motion is very impressive. So thank you for joining us on that. Allie, we're going to hand it back to you. Thank you for, we're delighted to join, and back to you, Allie.
Thank you, Jim, David, Hugh, for sharing your thoughts on the many changes impacting the private equity markets. You've given us no shortage of things to think about, so we appreciate that. Thank you. Just a little bit more to enlighten our audience. Our next roundtable event, our February call, is actually tomorrow, which is entitled Morgan Creek's Mark Yusko on the Future of Finance, Trends in FinTech, which will take place tomorrow at noon. Then it's a very busy week here. Then on Friday, the New York Alternatives Roundtable, along with the Connecticut Hedge Fund Association, will be participating in an event hosted by the MFA, which is the Managed Funds Association, focused on congressional and regulatory responses to the GameStop trading situation, as well as a look ahead for the next few months of activity in Washington. Tim Selby of Alston Bird, who's a board member and co-founder of the New York Alts Roundtable, will be representing us on the panel. It's open to all, and you should see an email later today with a link to register. This was something that just got put on our calendars. Then on March 4th at noon, the roundtable will host Wall Street Women 2021, our 4th annual all-female panel in honor of International Women's Day. We will feature Nancy Davis of Quadratic Capital Management and Casey Whalen of Truvo Partners, and it will be moderated by Sonali Bosick of Bloomberg. So thank you everybody for participating in today's panel. I hope you enjoyed the presentation. Stay safe, healthy, and enjoy the rest of your week.